Good afternoon, everyone. We all have gathered here for masterclass on secured credit, the only Panacea for MSME leading. Let's welcome on stage our speakers, Mr. Ishan Shah, Lead Research and MA, the Fintech Meetup, Mr. Ronak Shah, CEO OPL, Mr. Dhvanil Gandhi, Director MAS Financial Services, Ms. Sayali Karanjkar, Angel Investor, Independent Director. Put your hands together for our speakers.
Thank you so much. Good to see the room full. Also, this is not your typical masterclass where there's one person standing showing some PPT. We just thought we'll make this much more interesting and having a conversational masterclass. The topic is secured credit, the only panacea for MSME lending. We've seen how the secured lending specifically for MSME has been a flavor of the season for last couple of quarters, specifically because unsecured lending has been beaten down to a lot extent, and MSME, as we all know, has always been the large credit gap that has existed. uh, I'll just state some numbers, and I'll also introduce the panel. So we have a different mix that brings here. So we have Ronak, who brings a platform experience on the conversation. We have Dhvanil, who brings basically the balance sheet experience, and we have Sayali, who brings a mix of both consumer platforms, balance sheet experience, and how do you go about scaling such businesses. MSME lending, some numbers roughly seen around 14% growth year on year. The overall outstanding is somewhere around 14.3 lakh crore, out of which secured, which is your generally loan against property book, is around 11.5 crore, so which is a significant number. Some numbers around the MSMEs. Okay, this could be a mythological numbers because different people assess different numbers, but I'll just go by what's the official number. So total registered MSMEs are 6.8 crore, out of which manufacturing entities are 1.4 crore. Given this context, and the size has always been a problem opportunity together. What I'm going to do is we'll just open this discussion from how a lending journey looks like, right from onboarding, underwriting, managing the loan, and then final collections. So we'll go topic by topic and hear more on what does their experience states. So the first is onboarding and access, right? Generally, if you see, right, the way you evaluate a normal consumer finance business, or a consumer finance or versus a secured finance, onboarding journeys are quite different. Your RMs typically go visit, see, this is the property. On a consumer side, it's a very different, right? It's just straight through in today's time. What do you see in the second gap where the RM goes, there's a time lag, and how these opportunities are evolving in these sense? So starting with you, Saili.
Thanks, Ishan, and great starts to the session. Hello, everybody. The main difference I saw was difference I saw with the consumers, and while I was doing consumer lending, about 25% of them were actually MSME promoters, and they had reached their cap where they had taken a lap on their home and their factory, and after that they still needed money for their business, and then they would try in every avenue, including as a consumer for an unsecured loan. So that's how I started meeting some of them, and as I've continued journey advising different SME startups as well as doing something in the agri secured lending space, what I saw in onboarding is that you're underwriting the person and the other persons associated with that property, which could be family members and their connection with that property. So that becomes a complex task on its own. Second is that if your secured asset is beyond the property, so for us in the agri-tech space, we were doing commodity based, so it was grain. So we were also trying to assess the quality, the quantity, and the current pricing in that commodity market of that grain. And then as that became the secured asset, more than the warehouse or the warehouse rental, it became another area of assessment. So in secured, like LAP is of course the main scaled up and further scaling up business. But other than property, there's also other secured assets that are getting onboarded. And it could be grain, it could be consumer durables inventory, it could be vehicle inventory, and more of these ideas are coming up where you're onboarding the persons associated with that asset, the persons that are associated with the legal dissolution of that asset, and then the asset itself could have its own complex onboarding, whether it's a solar unit, a manufacturing unit, a grain, or something else. So the onboarding is getting more and more complex, but more and more diverse, because if we can make secure wider and understand that data and the blockchain itself can be a secured asset on which to lend, or the property itself or the asset itself, then we can widen the area of how MSMEs can be given credit to.
Got it. Understood. Dhvanil, I'll just add a bit to it, right? And when I say you, it means the overall systems, industry as a whole. So is there an inability to assess that risk if there's no collateral for an MSME? Because for, let's say, for consumers, people like us, it's straight through, right? We are salaried, we have monthly incomes coming in, and that's where a bank determines कि यार ये इतना दे ही देगा महीने के आखिरी में. So overall, as a system, where do you see that, given that onboarding challenges and the system's inability to assess risk without collateral, and you have a fairly brick and mortar structure as well. So how does it happen on ground for you? What changes you've seen?
So, thank you for this opportunity. I'll cover the onboarding piece and the underwriting piece as well that you talked about. I think consumer unsecured lending has been there for, I think, the longest time. I think everybody has played a hand here, right from international banks in the early 2000s to the PSU private and the NBFCs, and everybody has been a part of the ecosystem. So I wouldn't say that in absence of a hard collateral like a property, the underwriting becomes challenging or the customer is not lendable. There are challenges, and you have to be a very hardcore practitioner in terms of understanding the risk, understanding the customer requirement and all. I'm talking from the MSME context. Salaried and all is relatively easier because it's a very linear data, and then you assess FOIR and you just lend, right? MSME, it is more complex to underwrite them because there are a lot of, and especially smaller MSMEs are complex to underwrite. So I think there has been tremendous evolution on data within the last decade, I would say, which has made MSME lending without collateral also much more easier, faster, and more accessible. Secured was always there, but I think alternate data like GST, banking, and the UPI data and all has made a lot of difference in terms of how different lenders are creating different models to underwrite based on the risk and lend to them. On the onboarding part, I would say definitely secured is little more. In our terminology, we call it TAT, turnaround time, that how quickly we can turn around in terms of our disbursement or something like that. Definitely, secured product is slightly longer because there are two things. One is customer evaluation, second is the property evaluation. And that takes a little bit of more time. But I think over there also a lot of progress has been made. Say, for example, 5, 10, 15 years ago, if a proposal would take anywhere between, say, 1 month to 3 months to get assessed and disbursed, now NBFC like ourselves are doing that within a week's time or even lesser than that sometimes. So onboarding, it has to be understood that onboarding speed depends on the underlying customer. How formal the customer is, what data is available, how quickly can he furnish the documents and you can turn around and then lend to him. That's also a part that plays in the onboarding process. But I think there's a lot of scope for improvement on onboarding as well. But to keep a standard that something like a BNPL or an embedded finance or an unsecured loan as quickly as that, maybe there's still some more time before it reaches that kind of speed and ease of onboarding is what I personally feel.
Got it. Ronak, to you, I'll just add more to this, right? What Ronak was mentioning, right? What Dhvanil was mentioning, different MSMEs, different ticket sizes, different lenders have different ticket size also. Someone is doing a level above MFI, which is a micro lab, someone who's doing a 5 to 12 lakh, and someone who's doing 12 lakh and above. Across all these, the MSME profile remains the same, they're MSME categorized. How have you seen the onboarding journeys within your platforms or other platforms industry wide change in last couple of years?
Okay, hi Ishan. Good afternoon, everyone. See, the key point is if you look, India is a very data rich country, okay? And the advantage today we have that data is not that expensive, easily available through API, through the sources and all that stuff. So let's say post GST, after digitization of GST or your ITR or bank statement analysis and all that stuff, today we see that onboarding of a borrower, be it let's say a microfinance consumer up to 50,000 or a mudra consumer up to 10 lakh and now 20 lakh or up to 5 crore also, it's probably more or less the same process where certain data points won't be there in low ticket size loans, but it's very easy. And today morning, if you would have attended a session of CS Shetty sir, chairman SBI, there also he claimed that today they onboard MSME up to 5 crore in 25 to 26 minutes, and that entire infrastructure we have played a key role into it. So see, today the thing is onboarding of a borrower has become very simple thanks to digitization and the datas which are available. Second thing is it's little bit of myth, or probably yes, 5, 7, 10 years back, majority of the loans used to happen collateral based because new age data models or risk analysis models were not available. But now today with digitization of data and all that stuff, if you look at it, banks like largest of the banks, 65 to 70% of that portfolio up to 5 crore loan is collateral free, and those loans they onboard customer or give eligibility in less than half an hour, and probably those loans are disbursed in a day or maximum 48 hours. And new digital journeys coming up and banks adopting those journeys, these journeys are becoming much faster, and collateral is becoming probably a thing. Now mudra, one last thing which I would add, where we know that accounts are more than 50 crores and all that stuff, that it's mandatory that those loans up to 10 lakh and 20 lakh happen collateral free. So it was earlier in certain sections, yes, where those things are not available or still they don't have those data sets. Banks might ask for some collateral or gold based kind of stuff, but other than that, majority of the loans today are moving towards collateral and banks are doing it. So that's, yeah.
Got it, understood. Thank you. Moving on from onboarding to underwriting, secured lending is basically asset first risk profiling and pricing, right? Do you see any shift happening towards enterprise first, which is the core MSME enterprise first? And somewhere, do you think are we over collateralizing the MSME, right? The requirement could be of 3-4 lakh, but the guy is kind of in a situation where he has to pledge his property which is worth 15-20 lakhs. This is where most of the secured lenders are operating. So are we in a situation where we are doing this? Right?
Yeah, so when sometimes you underwrite a startup, you would be like, karoge kya iska? The use of funds becomes very important. But we don't always do it when we underwrite that startup's customer, which is this MSME. So I see manufacturers especially, right? They have seen both sides, where if their home value is say 20 lakh and they need 5 lakh at that time, they will still need to draw 15 lakh. And when they need 30 lakh and their value is 20 lakh, they will still be capped at 15 lakh. So as the SME grows, whether they're doing revenue and they need 5 lakhs, or they're trying to grow beyond the house value that they have or the factory space value that they have, they're still hitting at the same limit. So how can we get better at underwriting these people and using their collateral, but also taking more and more off, to your point, that taking some of it off the collateral piece and using the collateral as maybe a first loss kind of lever versus using it as the only lever to assess the value that should be given to it. And my second point is that what else is secure? Is the customer that's buying from that SME, if that customer is a AAA rated company, isn't that a secure lending as well, right, towards that receivable. Or if they are exporting to a company that is very, very strong, isn't that 90-day period actually a secured loan, because that is definitely coming after the customs receipt is uploaded? Or is, as in agri-tech that I was seeing closely, like if you know the value of that millet, then why is that anything about the warehouse ownership and the warehouse value? It has to be warehouse value and a factor of the actual grain value and your trigger price at which you're selling it. Similarly, like with the solar, you know how much money that solar unit is going to make because of its exact contribution to the grid. Then why isn't that calculation more important than the value of the house on which roof the solar unit is placed? I think we need to stretch the thinking. We need to use our skills in data analysis to look not just backward looking at the current assets and its current market value, but the forward looking asset of what that use of funds is buying. So if it's buying a new unit, what's the forward looking revenue, what's the forward looking potential of that asset, and underwrite to that versus just the current property.
Got it. That's a good startup idea. Dhanil, same question to you. Are we over collateralizing MSMEs?
So I think what you talked about, asset first or enterprise first, I think a lot of lenders are moving, and with our vintage of 30 years where secured came in very recently for us. Before that, most of our portfolio was unsecured in nature because we were catering to the micro enterprises. Our approach, I can talk about our experience at Mass. Our approach was always cash flow first. That irrespective of what security the customer has to offer or doesn't have to offer, is there the cash flow? As a lender, the first thing that you look at is, apart from the asset, obviously, why we look at asset is from our perspective, is as a backup security, that in case something goes wrong, then are we able to recover our money by liquidating that asset? But we are not in the business of repossessing assets and selling assets, right? Or houses, buildings, or whatever. So we make money if the customer keeps on paying the EMI for say 3 years, 5 years, 15 years, whatever the tenure is. So our focus, and I think a lot of other lenders are also moving towards this now, is that property hai, 50% de do, look at nothing else, now is slowly and gradually fading away, because cash flow assessment with obviously the new data and everything availability which is coming in is becoming more prominent. Earlier what we used to do, we used to create perceived balance sheets. Now we can pull ITRs through an API, GST through an API. पहले ऐसा सब नहीं था, तो our credit guys, underwriting guys would go to that guy's place, spend half a day there, see the footfall, the movement, create a balance sheet, because he doesn't have a balance sheet. We created a perceived balance sheet, that this could be the potential balance sheet of that borrower, and can we lend this much or not. So the right approach, we feel, should always be more of enterprise cash flow than the asset. Asset is important from a lender's perspective, and what Sayali was also talking about. Now, alternate assets is definitely an option if an ecosystem to liquidate that can be created. Why lenders focus on hard collateral like property is because of the ease of liquidation and the long history that it has carried. If an ecosystem can be made where, if I take agri grains as a security, and if there is a ecosystem as a lender for me to liquidate and recover my money, then that is something that can also work out for varied businesses. So this is the view on the enterprise versus the asset piece.
Got it. I think that's an interesting point, because it's still not that easy to liquidate that an asset, because different states have different regulations. Rajasthan has that patta rule, Maharashtra has
Every
Satwara
state has
rule,
different legal, technical
rules.
nuances. Then there are panchayat properties, there are municipal corporation properties. So then this in itself is a big maze which one has to unlock. And then the most important part is that, are you valuing that asset correctly? When as I as a lender go to the market to sell an asset, then obviously it will be under pressure, because they know that it's my requirement to liquidate this asset and get the money back. So we have to work with the customers that maybe you should liquidate it and get the money, then there's potential to recover more dues from it. So the property in itself in India, because of the diversity, is a big challenge to understand and decode.
Got it. On that, RBI has been working around, creating a standardized format where all all the states in India put out the property title rights clearly via an API where it's easily accessible. Right now, I think 11 odd states already have those APIs with RBIs. But good point on
So it
that.
would become like a bureau of properties. So
Bureau of property,
that's
yeah.
the way going forward, the way that will happen.
Correct. Ronak, this just moves on to the platform piece again, right? Lot of data. Again, like if this piece of property data being available just through an API where you can actually value it also, whether Ishan Shah is the owner of this property or not, versus sending someone there. What other data sets you see that have kind of matured enough to underwrite these MSMEs, and we move away from a asset first to an enterprise first? Like your recent experience, what does it say?
Okay, hi. See, the key thing is first addressing today banks take a collateral, okay, but it's not their job to liquidate that, and how many percent are they able to liquidate, because it's a long drawn legal battle and all that stuff. So see, now there is cash flow based lending which is coming up. So Dhvanil just said that they were doing, but probably it's a new concept which all the banks are adopting. And thanks to GST data and sales and purchase, all those lenders getting, it's becoming much easier to lend not only on cash flow models, but let's say to lend on individual invoices also. So those are the kind of new age models which are coming up. Now, thanks to CGTMSC, which has increased up to 5 crores also. Okay, so most of the lenders are not looking at collateral based, and through digitization, when they get all those data to analyze their new age risk models, probably most of them are moving away from collateral. So one new wage coming up is, let's say, anchor based lending also, because in India we know that at the start of the talk you said 6.8 crore MSEs, some say that it's 7.5 crores, and out of that 1.2 crore file GST. So to do cash flow based lending, you'll get data of all those guys or their invoices from GST. But let's say balance, where do you get those data? And in India, we know that 30 lakh crore is addressed market, but equal amount is still unaddressed market. And those guys don't have those kind of data sets. Probably half of them won't have a banking account also, so to say. So that's where this ankle-less system, where one of the case studies we have already worked out with SIDBI for Jan Aushadhi Kendras, where through central ERP system you get their sales and purchase data, and basis that you analyze and fund them. So similarly, that's a big ecosystem which we are developing and working closely with quite a few anchors, where you get that data where data sets are still not available, but you cannot go on a collateral based journey. Or I'll tell you, the mindset, the way now at lenders is changing, is no one is interested in collateral based lending, and they want new risk models and cash flow based analysis. So that's where the entire ecosystem is moving.
Got it. Thanks. We're still on time. I do have a couple of points left, but just want to open up for audience as well. Just want to make this much more interactive, if you're all okay. Just any quick questions, we'll just keep on checking. Yes. So can we have a mic around there?
I'm Ravi.
Yes.
Hello, I'm Ravindra Mishra. I was DGM heading SME operations in State Bank of India. So my question is, when we used to discuss internally also, we used to discuss about the cost also, taking the collateral, keeping the documents, every year audits, every year legal audits, then going for the recovery, and recovery also is 1/3, 1/4 of the value. So how do you see that is also getting an impact on this?
Dhvanil, would you want to take that? Just try to add to ops plus cost of capital, because capital is what would only differentiate.
So I think in the Indian context, cost of capital definitely plays a very important role. But as you rightly mentioned, that is a very tedious, operationally intensive task where you have to build up a lot of team to manage all of those things, and it just increases the overall cost. So OPEX, and then it has a direct impact on the profitability. I think some technology interventions are coming in now. We are talking with one or two players wherein they are giving solutions where they, in a way, you can outsource this function of valuing the property, then safeguarding the documents and all of those things. So some tech intervention here will help. But what happens is that because these are very, very sensitive documents, because these are the houses or the offices or the factories of the entrepreneurs, you have to be very careful that you don't misplace or you don't, an accident doesn't happen. So I think lenders still are keeping the old ways going on. So it will take some time for this thing to go away. And what happens is that indirectly this cost gets added in the interest that we charge, because it's not that the lenders are going to incur say 4 5 6% opex just managing all this show, because eventually you need to make money, and where does that go? That in a way goes to the borrower has to bear it. So I think the problem is still there. The solution is not that obvious right now. I think we will have to look for some intervention from the tech side to see that if things can improve. But as he rightly said, liquidation is also a big challenge. I think I was reading some data, and it is taking anywhere between 500 to 900 days, so almost 2.5 to 3 years from repossessing to liquidating a property, even after IBC, SARFACI, and all of those norms are available to lenders. But still, it's a big challenge in the Indian context to repossess and then sell.
Got it. Any more? This one question.
Yeah, Dhvanil, you talked about
Could you also introduce yourself first? So,
Yeah, hi, my name is Vikram Nirula, and I'm a founder of a firm called CreditServe. It's a tech firm. Dhvanil, you talked about income assessment. Could you tell us what is the industry doing now with technology to improve the ability to assess income for MSMEs? Because if you have to move towards less collateralized lending, I guess that becomes critical. So could you talk a little bit about that, and also the challenges that you face in the Indian context? Thank you.
So I think on the assessment part, 2 3 major points which are practiced industry wide is that after the onset of UPI and all, the bankings have started getting a little more populated now. Earlier, say 10 years ago, if you would look at bank statements, there would hardly be any 4 5 6 entries in a whole bank statement in a month. Now all those things is improving. So bank statement is one. Second is GST data. That is also available on a click from the source with consent. So if the firm is registered under the and is eligible under the GST registration, so GST data, banking data are the two main these things. And third is the bureau data. Because bureau also has taken a very good shape in terms of how the regulator has also mandated the lenders to now report loans on a very frequent basis. So combination of all of those things, bureau, GST, banking, and over and above that, you meet the customer and talk to them and then take a decision. The speed and the amount depends on how much of intervention do you want. We are experimenting currently with embedded finance through payment gateways, through payment service providers, not gateways. And over there it is zero intervention. But then the ticket sizes are 1 lakh, 2 lakh. You can't lend 50 lakh, 1 crore, 1.5, 2 crores like ticket sizes without any manual intervention. That's not possible. So a combination of all of these sources is helping the assessment take forward in terms of alternate data and all. And the key thing here will be how the lenders create their own models. GST data is available to all lenders. How you use that data, how you build risk around that, and what things do you look at, what things do you deep dive into, will differentiate between, say, a 2% credit cost versus a 5% credit cost. That's the main differentiator.
got it.
I just want to add one point to it. Like, of course, the GST data is adding to how you can underwrite better the cash flows. But one thing I saw in supply chains is that if we can create a closed loop using an anchor, whether it's an FMCG company and all their even tier 1, tier 2, tier 3, tier 4, all of their distributors, small distributors, suppliers, then that closed loop system with the goods data. So either you assess the flow of funds or you assess the flow of goods. And while their transactions might not show up in the payment system because a lot of it from the kirana to the customer might happen in cash, it helps to understand the goods that are flowing. So one loop was the funds loop, which is through GST. The other loop is the goods loop. So whether you track the goods from the truck data itself, from how much is passing through the highways, but it's also through the inventory assessment or the ERP system at the store level or the bigger distributor level. And that gave me an interesting insight of that having more coverage than the payment gateway data at the store level. So that was another piece.
Got it. Ronak, to you, generally, when you monitor a loan, right? If it's a secured, then does the lender actively monitor it, the asset, or do they go about monitoring the enterprise, or do they go about monitoring the cash flow? Largely, it would seem most lenders would not do if they're doing secured lab specifically. In my assessment, and could be my personal view as well, not seen active monitoring of that asset happening. So monitoring and evaluation across these three buckets, what would play out much more better?
See, for all the banks, Ishan, it's mandatory that every year you have to renew the account. Okay, so it's not that they are not monitoring, but the key question is where they have lakhs of accounts or probably those kind of stuff. How do they monitor those accounts regularly? Because manually or physically, it's not going to be possible. Okay, with whatever branch strength they have or human strength they have, because when you have, let's say, a bank like SBI has got 17 lakh MSME accounts, or put to all together all these banks would have close to 80 lakh accounts. Now it's manually or physically not possible to monitor them, but it's mandatory by regulators that every year you have to renew those accounts. So that's where digitizations play a very, very critical role. And again, as we say, where those guys are filing their GST or ITR or they are existing bank customers, they do it through analysis and digital analysis of that, and those can be done in minutes and hours. So that monitoring, the way it used to happen earlier, where probably those genuine monitoring was happening or not, but thanks this renewal and digitization, quite a few banks have adopted that process and it's happening. Now let's say where it's small ticket size cash flow based loans, okay, there we should understand that everyone is talking about cash flow based and she talked about goods and all that stuff, but those are small duration loans, 30 days, 90 days, 120 days. So there by default in 30 days or 60 days, if your account is not paid back, it's not a monitoring, but it's a sign to you that yeah. So probably in those small ticket size cash flow based loans, monitoring happens by default, because those are not long term loans, and for other ticket size loan, it happens through regular annual renewals. So that's how it's moving towards now.
Correct.
One interesting monitoring use case we built was using IoT devices in agri-tech. So let's say the harvest season for dal is in March and it's going to get sold through the year. So you're giving it based on the dal you have. So you've done the initial assessment of the quantity and quality and fumigation levels, etc., moisture content, all of that at the start. And then you continuously monitoring using a camera, and the camera, because you know the initial size of grain and volume of grain, you can keep understanding that and understand not only the quantity but also the quality, because the moisture content or the fumigation level will change the size of the grain. So there is a inspection process which is not smart and can be done by the person on the ground, but the data assessment, which is from the camera images to the back end, is very smart, and you don't have to send officers who can then be corrupted by tons of people on the ground. You don't have to rely on all of that for monitoring through the year. You can rely on the data that you have and the trusted but not smart resource on the ground. So that changed how we assessed it.
Got it. See, collateral reduces information asymmetry to a lot extent, right? And so can data, if the data is accurate and it's massaged properly and you get good insights out of it. So purely from a system design point of view, let's say today you would want to start a NBFC, which is specifically into SME lending. you would want to keep it secured and secured both. So from a pure keeping it lean, not going the branch model, because this question is especially coming because last 18 months, if you see all the new NBFCs that have come up or the family-owned NBFCs that are there, Hiranandani Financial Services, Tiger, and a lot of these have genesis from the start as a secured lending against collateral, physical property. So if you have to start, how could you design that way and then you go about it?
I mean, definitely secured enables how many how many SMEs you can cover and the way you can cover them. But I would like to look at secured in a wider way than just property. So as I said, goods, or as I said, inventory, as I said, maybe an export receipt, maybe the stock that is kept at customs, maybe the stock that is on the ship. So a lot of different ways to think of secured. And for me, being a data-oriented person, and I believe that if the entire supply chain is stitched in a closed loop and is on a blockchain, that would become the secured asset for me, and I would lend on that. So yes, the SME lending will have to do unsecured, secured both. But while doing that, we need to innovatively think of how wide can you cast the net to still make it secure. And also, I would add the way you release the capital. So the point for me is always that there is a pre-money, right? So how the money is coming, what is the supply side, where is this money coming into the NBFCs, and there are a lot more players who want to grow their MSME books. But how are we then releasing that capital? So what are the securitization methods? Are we using that to create fixed yield assets in the market? Can we take a really good book, just like a gold book is released, can a bitumen oil book that is on the customs and has passed, can that be released into the retail market as a fixed yield asset? So I think the more we innovate on what is secure and what is the flow of pre and post money on secured, the more we can do for MSMEs.
Got it. You want to add something?
See, as you said, but my advice to new age NBFCs is that forget collateral based. And I'll tell you the classic case is when you are going in small ticket size, and let's say less than 5 crore is 98% of India's market. Whatever kind of collateral you might take, you might not be able to, after bearing all the cost and all stuff, realize more than 30, 40, 50%. But now through CGTMSC, if you do, then it's an insurance kind of stuff, and 75% of your fund is secured. Then why do you want to go into collateral based security when government is giving those kind of securities? And earlier, see, there were no models, but today, now thanks to data and all that stuff, we at OPL have developed certain scores. Okay, we call it fit score, and now we are taking a step forward into that also. A layer one score we are coming up with, where you can fund NTCs also, because these are AI algo trained models through various datas we have over the years and all that stuff. So when you have got those kind of new age risk models in CGTMSC, why do you want to go in collateral based lending? That will be my bit on that.
Got it. Dhvanil, a lot of these data points that both Sayali and Ronak discuss, right? Most of these are at an ecosystem level. And in India, we have seen from an Indian fintech or financial services, all of these data sets that have come usually top down, and most of these solutions have been built top down. So UPI, ULI, Aadhaar, everything. It's not by one single entity because it takes a lot of effort to go to every bank, to build out and do all of these things. So within your assessment, the way you lend to SMEs, both secured, unsecured, what data points you think are missing, which would eventually come from top down and not from bottoms up?
So I think in the Indian context, as long as there is a parallel informal economy which goes on, it will be difficult to get all the data even from bottom up, which is reliable. I would say reliable, genuine data. As long as that form parallel economy is going on, it will there will always be this differentiation. But I think in terms of if you ask us that in terms of data right now, what I think we are more than happy in terms of the visibility that we have. So how we divide it is that past track record through bureau, current financials business through banking, GST, financial ITR statements, and going forward visibility also can be mapped based on that. So I think data wise, I'm not able to think of much which can come from bottom up, but whatever regulatory data which is available, I think more or less everything is now there. Even in salaried personal loan, we have EPFO data and all to rely on. So all that data is there. It is just about striking the right balance between uh, how much you can rely on data versus how much you will have to rely on the credit underwriter's judgment at that point of time when he's underwriting that borrower. It's a combination of both. So data is one part, but that doesn't solve the 100% of the problem, because if data was to solve 100% of the problem, then this ecosystem of say large to small institutions wouldn't exist. There is still some arbitrage in terms of understanding the borrower behavior, understanding the borrower, and then taking a decision, which is important.
Got it. Quickly, you touched upon bureau. How has the bureau score for particularly this segment evolved? Like for consumer, a lot of other data points have come in, but this segment, you've not really seen much happening. Maybe I could be wrong, but what's your assessment on this?
So I think entity specific, but there is corporate bureau which is available. All the bureau agencies have corporate bureau. Then there are companies like Sibyl who give a CMR ranking, and others also have similar kind of rankings which is there. So I think those guys are also trying to build models for the corporate bureau score for the MSMEs and not only the consumer side. So I think the data is getting there. I think good amount of data is available, and I think banks and all depend a lot on the CMR score as well. So I think bureaus are doing a decent job in terms of capturing that and converting into model scores and all of those things.
Got it. So we've touched onboarding, underwriting, monitoring, the favorite part of all lenders, collections. Because it's a business of collections and not giving money out. So we'll just quickly touch on that. Collections to a large extent has remained stagnant, right? A lot of people have tried to build some models around it, but still after starting a collect tech company, you have people putting up call centers, calling up people, recovery and all of those things, right? Collateral does improve your collection efficiency to some extent. We discussed on how it can get tangled into legal issues and stuff like this. But on how do you go about addressing collections specifically in this space? Anyone can.
Okay, see, I'll keep on going to cash flow based lending and short term. Now, their collection is very simple because when you lend to those guys, you take INASH mandate along with that. So at the end of the tenure, let's say 30 days, 60 days, 90 days, it like a personal loan, home loan or auto loan, it gets auto debited from your account. The only thing is those MSMEs or let's say not even MSMEs, micro and small enterprises need to have balance into that. But there are various repositories which are coming up, and let's say SME defaults on those 1, 2 or 3 invoices, then probably further lending will be stopped. So collection is becoming for small ticket size loans a very simple process where you take INASH mandate and at end of the tenure it gets auto debited from your account. So that's becoming interesting. Taking just a minute on further point, bureau, okay. See, bureau, the thing is it's only created whatever those models and all that stuff on the past or the credit history behavior of the borrower. Now let's say the time when a tough time like COVID, if you would have gone through anyone's bureau score or a CMR score, or it would have been that no lender would have been lended or probably would have been lending worthy. Now that's where these new age models are coming up, and as I told you, AI based scores we are developing where they are bureau plus plus. So today GST, ITR, bank statement, when you have data of so many SMEs and you train your models along with bureaus, you come out with a probability of default curve. So that's where it helps, and people have started looking just beyond the bureau. And from bottom up, which you are talking about, see, UPI, as India is data rich, we said, and UPI is the kind of data no country in the world has, because those are actual financial transactions happen between an individual and a retailer or someone. Now the day UPI open up those APIs, probably there are already models which a lot of fintechs like us and banks have worked out. It's we are just waiting for UPI to open up those data, and probably, as you are saying, that grassroots level change in underwriting models is about to happen. Now it's on UPI when they open up those data sets.
I'll add a point on the price of the asset as well. So collection, we talked about the difficulty in getting that property liquidated, sold, etc. But also depending on which asset you have, whether it's gold or grain or something else, you have to have almost a hedge fund like activity where you know where the commodity price is going, and depending on that, having triggers in your contract itself to liquidate that asset if it falls, the price falls much below your loan amount, let's say. And the next point will be based on against the flow of goods. So if you can release the goods only on repayment, then your loop is so tight that collections doesn't become the necessity, but your underwriting loop is itself too strong and your repayments are coming through the sale itself.
It's an interesting observation. Yeah.
So I think this what you talked about, ENACH, UPI, autopay, all of those things have helped. The advancement in the payment ecosystem has helped in collection a lot. I think that has played a good role. And on your other point, collateral reduces our loss given default. It doesn't have a direct impact on the collection, but it reduces the potential default that a lender could face. So that's the advantage that a collateral would have. But on the payment side, collection side, yes. So payment system advancement has helped a lot.
Got it. I've been told time's up, but I think we've fairly touched the entire lending life cycle of a MSME. Any questions? Happy to take offline. Much more there around here only. Thank you so much. Thank you for patiently listening to us. Thank you. Thank you all for the insights.
Thanks, Ishan.
Well, thank you so much.